Today, we're going to connect two worlds that seem like they're complete opposites: the fast-paced, high-energy screen of a day trader and the quiet, methodical boardroom where the rules for the entire global economy are written. You're going to be surprised, I think, at how deeply one really depends on the other.
So, let me ask you this. What could a YouTuber teaching Forex and, a global accounting committee possibly have in common? It's a weird question, right? One is all about split-second decisions and taking risks. The other is about careful, deliberate rules. But the answer, well, that's what connects the dream of trading to the very foundation of our entire financial system.
So let's start in that first world, the world of retail trading. It's just absolutely exploded in popularity, hasn't it? And it's often sold as this pathway to a totally different life, one with ultimate control, ultimate autonomy.
I mean, this quote from a popular trading guide just nails it. It perfectly captures that promise. It's not really just about the money, it's about getting total control over your life and your time.
And here's the thing, the barrier to entry has never, ever been lower. All you need is a phone and an internet connection, and boom, you can basically become the CEO of your own trading desk. You decide when to work, what to risk, and you can do it from literally anywhere in the world.
Okay, but if you're going to be your own boss, you've got to know the business, right? So for anyone chasing that dream, the first step is always the same. You have to learn the absolute fundamentals of the market you're about to jump into. And the biggest market of them all is Forex. The idea behind it is actually pretty simple. It's kind of like when you go to an airport kiosk to swap your dollars for euros. Well, the Forex market does that same thing, but on a massive, global, digital scale, 24 hours a day, 5 days a week. And when I say massive, I mean it. The scale is just staggering. Over $5 trillion are exchanged every single day. All that volume creates this giant liquid marketplace where individual traders like you and me can jump in right alongside the world's biggest banks.
Now, here's a key thing to get. You're never just buying a currency. You're always trading a pair. So if you buy the euro-dollar pair, what you're really betting on is that the euro will get stronger compared to the dollar. You're buying one currency and selling the other at the exact same time. That's the building block of every single trade.
All right, so that's the trader's world. But have you ever really stopped to think about what these things they're trading, what they actually are? I mean, every stock, every bond, every instrument has an origin story that starts way far away from those price charts. And that brings us to a really critical question. We know what traders do, right? But when a trader clicks buy on a company's stock, who actually defined what that stock represents? What makes it a real, legal claim on a company's future and not just some digital blip on a screen? Well, the answer, believe it or not, lies with organizations like this one. This is the IFRS Foundation. Through their International Accounting Standards Board, they literally write the rulebook, the accounting standards used by public companies in most of the world. Think of them as the architects of the language of finance. And here it is. Here's the connection. What a trader sees as an asset on their screen, the company that issued it has to record as either equity or a liability on its balance sheet. And the rules that define that little distinction, they are incredibly precise, complex, and super important. And right now, these rule makers are trying to solve a really tough puzzle that gets to the very heart of corporate finance. What does it really mean to be an owner of a company? Because as it turns out, not all owners are created equal. So here's how the problem kind of breaks down. On one side, you have your ordinary shareholders. They have what's called a residual interest. Basically, they get whatever's left over after everyone else, like lenders, gets paid. But then on the other side, you have holders of things like preference shares. They might get a fixed payment, which makes them look a whole lot more like a lender than an owner. And this is where things get messy. Financial innovation has made these lines incredibly blurry. You can have preference shares that also get to share in the profits, or different kinds of ordinary shares with special rights. For an investor trying to figure out the real pecking order of who gets paid when, it can be a total headache. Let's just take a perpetual instrument, for example. It's technically equity because it never has to be paid back. There's no maturity date. But it often pays a fixed dividend just like a bond would. So is the person holding it an owner or are they a lender? The answer is, well, it's complicated. So, to cut through all this confusion, the standard setters are proposing a new way to do things. Their goal isn't to change the instruments themselves, but to change how they're presented on a company's financial statements, just to make things clearer for everybody. And their approach is actually pretty logical and straightforward. Step 1, identify all the instruments that act more like debt. Step 2, pull them out and show their value separately on the company's books. And finally, step 3, group all the true risk takers, the ordinary shareholders, together. Simple.
Look, the end game here is simple. It's all about clarity. An investor should be able to look at a financial statement and see, at a glance, exactly how the pie is sliced, who has a fixed claim, and who gets what's left over, whether that's a huge upside or a big downside.
Okay, I know we've been deep in the weeds of accounting rules, but how does any of this connect back to that trader glued to their screen? Why should they care about any of this nerdy stuff?
Well, it's because a trader's decisions aren't just about squiggly lines on a chart. They're often based on fundamental analysis, which means digging into a company's financial health, and that analysis is only as good as the numbers it's based on. These rules make sure those numbers are trustworthy, consistent, and comparable from one company to the next.
At the end of the day, that freedom and opportunity that pulls people into trading, it can only exist on a bedrock of trust. Trust that the numbers are real, trust that the definitions are consistent, and that trust doesn't just appear out of thin air. It starts quietly in the pages of an accounting rulebook. So, the next time you see a price chart move up or down, maybe you'll think about that incredibly complex rulebook that defines what's actually being traded. From the trader's dream to the accountant's reality, it's all connected. That simple click of a buy button, it's really the final step in a long chain of definition, regulation, and trust.